For today's video, I thought I'd go through what is a PE ratio, price to earnings ratio. There have been a number of inquiries on the channel, new investors, new viewers to the channel, wondering exactly what do I mean when I refer to a PE ratio. So I thought I'd kind of go through what is that metric, how is that metric calculated, what is it telling an investor, and then how do you use it to evaluate stocks, whether a stock is expensive or cheap. As you can see up on screen here, a PE ratio is a price to earnings ratio. It's one of the most popular valuation ratios used by investors. It's very easy to calculate. Simply take the market price of a stock divided by the earnings per share. So for example, if you want to do a current PE ratio, simply get the price of the stock, find the last 4 quarters of earnings, add those up, and divide that market price by that earnings per share for an entire year. That gives you a number. You can also do that as a historic number as well. Let's say you want to know the PE ratio of a stock in 1980. Simply get the price of the stock in 1980 divided by the total earnings for the 4 quarters in 1980. Do the same type of calculation here. Market price divided by earnings per share. And it gives you a historic PE average that we'll talk about why you'd want to do that with a particular stock's PE ratio. So now that you have configured that particular number, what is that telling you? Well, it's simply telling you how much an investor is willing to pay for a company's earnings. So for example, if a company has a PE ratio of 10, we'll just do this in a very simple fashion. Let's say the stock has a stock price of $10, has $1 of earnings per share per year. So 10 divided by 1 equals 10. That is telling you that an investor is willing to pay $10 for every $1 of earnings in that company. If the PE ratio is 100, again, let's keep this simple. Let's say the stock price is 100, it has $1 of earnings per share for an entire year. That PE ratio is 100. You can see that stock is relatively more expensive than the prior. The investor is willing to pay $100 for every $1 of earnings in this stock, whereas that prior stock, they were only willing to pay $10 for every dollar of earnings. So a PE ratio utilized in this fashion gives you the value of a company, the value of a stock. What is an investor willing to pay for a particular stock? So what is that essentially telling you then? Well, it's essentially telling you that a PE ratio, the higher the PE ratio, the more investors willing to pay, the more valuable that company is. The lower the PE ratio, the less an investor is willing to pay for that company, the lower value that investors place on that company. So it's a way of evaluating a company regardless of the stock price. The PE ratio also lets you kind of get an insight into the company moving forward as well. Typically, companies with high PE ratios tend to have greater future growth prospects. So you can think of these as the Googles, the Apples, the Amazons. They have very high PE ratios because essentially an investor is willing to pay for future earnings. So whereas a company may have very low current earnings per share, an investor thinks that a company's future earnings will be much, much greater. So for a Google, for example, hypothetically, let's say today it has $1 earnings per share per year. Investor thinks in 10 or 20 years that may be a 100 or 1,000. So they're willing to pay much more for each share of stock, even with low earnings, equaling a very high PE ratio, because they think in the future it'll have very, very good earnings, and they're essentially buying the stock before that happens. So that's the whole idea behind growth investing. It's much more risky. There's no guarantee that a company's earnings will increase, but if they do, you'll make quite a bit of money on that growth, because as the earnings increase, the company's stock price will increase as well as more investors jump into that stock. On the other side, you have companies that are well established that don't really have lots of growth prospects in the future. So stocks with low PE ratios tend to have lesser future growth prospects. And you can think of this as, for example, Ford, Procter & Gamble, some of the very well-known blue chip companies, Coca-Cola, for example, that are very strong companies that will be around for quite a long time. They're very safe companies to invest in, high-quality companies, but their earnings per share are typically not going to increase much moving forward. So they're strong companies, very valuable companies, but an investor doesn't think that stock price will go up because their earnings per share won't go up. So the PE ratio tends to be quite low on these particular companies. Again, these companies are solid companies, and these companies typically have a very good dividend yield. These are more of the dividend investor, buy and hold, conservative investor that wants to get into a stock that they know that the earnings will stay stable moving forward. The price of the stock won't dip down, unlike a growth stock. So that kind of gives you an idea PE ratio, whether a company is a growth stock, more of a dividend investor, buy and hold stock that will be a very safe bet moving forward, less risk, but less reward as well. And as I've often said in my videos, risk equals reward. Growth stocks are much more risky. They will have much more reward moving forward if they succeed, but again, there's that downside risk as well. So that's kind of how a PE ratio is configured, how it is calculated, and then what it's essentially telling an investor. Again, if you guys have any great video ideas, if you guys have any questions on this video, other videos, please let me know in the comment threads down below. I'm always looking for new topics to read up on and new videos to put out kind of based on what your guys' interest is. So please let me know in the comment threads down below. And kind of with that, I'll end the video, and we'll see you guys next time.